Okay.
Okay, sir.
Okay. Okay. Can you all see my screen?
Yes, sir. Can say.
Right. Okay. Okay. So let me start uh, with the balance part of ISA 540. So in the last Sunday, actually, we discussed up to identifying and assessing the risk of material misstatement. Then basically responding to assess risk of material misstatement in relation to accounting estimates and fair value accounting estimates. So that there are two things at high level which we need to consider: whether the accounting the accounting estimate meet the requirement of a financial reporting framework in relation in respect of recognition, measurement, presentation, and disclosure. That's the first thing. As an example, share-based payment, whether the recognition, measurement, and presentation and disclosure criteria have been met. The other one is methods for making the accounting estimate are appropriate. Methods or the model that have been used by the organizations are appropriate and have been applied consistent. So that is very important. So I explained method, assumptions, and data. These are the three things which will be used by an organization when they estimate and the value for an accounting estimate. So the accounting estimate cannot be measured precisely but can only be estimated. So you need to have a method or model which may be entity specific or a method that is generally accepted or generally used, or this method which is specified by the standard, like projected unit credit method, and when you do the uh, uh, actuarial valuation of defined benefit obligations, right? Then any changes to the method or the model is appropriate. So that is also very important to understand. So one is the method or model to be applied consistently from one year to another, and then any changes are supported with valid reasons. Then whether the data and assumptions used are reasonable. So those are the things which we need to consider in responding to assess risk of material misstatement, right? In responding to the assess risk of material misstatement as required by SLAS 330, which is ISA 330, responding to assess risk of material misstatement, the auditor shall undertake one or more following. There are three approaches which an auditor can take. So, taking account of the nature of the accounting estimate. Audit procedure whose nature, timing, and extent are to be responsive to the assessed risk of material misstatement in relation to the accounting estimate at both the financial statement and assertion level. So, as part of the risk-based audit approach, we identify risk of material misstatement at two levels: at financial statement level and at assertion level for classes of transaction, accounting balances, and disclosures. So some of the accounting estimate, so we would identify risk of material misstatement. So when it comes to accounting estimate, the risk of material misstatement at assertion level. So as standards specify, there are three testing approaches an auditor could use, either individually or in combination. The first one is obtaining audit evidence from events occurring up to the date of the auditor's report. So basically, we are looking at the audit evidence or the events that have taken place since the balance sheet date to the audit report signing date. As an example, there is a provision for bonus. So you check the subsequent payment. In simple terms, if there is an accrual, you could check the actual payment and then to consider whether there is an underover provision or there is a misstatement. So that is when it comes to very straightforward uh, accounting estimate. Obtaining audit evidence from events occurring up to the date of the auditor's report, that is from the date of the balance sheet to the auditor's report. Provide audit evidence regarding the accounting estimate. If that is not there, testing how management has made the accounting estimate. So that is what is the method or model they have used, assumptions they have used, and data that have been used for the purpose of arriving at the accounting estimate. So the number two is testing how management made the accounting estimate and the data and assumptions on which it is based. As an example, warranty provision. So what is the method or model they have used, which is definitely an entity specific model. Then the data they have used. As an example, few past claims which have been entertained during the warranty period. Also likewise. Then the assumptions, whether we expect the same pattern in the future. Oh, as an example, if we have improved our production processes, are we expecting less claim in the future? So likewise assumptions, which is based, right? In doing so, the auditor shall evaluate whether the method of measurement used is appropriate in the circumstances and has been applied consistently. If there is a change that is acceptable, right? So if you go back to this method for making counting estimate, is somebody ask a question or somebody raise the voice?
So it seems a mistake.
Right. Sorry, no problem. So, whether the method used is appropriate and whether that has been applied consistently. So, the consistent application is very important when it comes to accounting, and you can change it. Now, as an example, when IFRS 16 came in, was adopted, so all these operating lease arrangements that were off balance sheet item up to that point were recognized. So basically, the lease liabilities and then the corresponding right of use asset was recognized. So that is as per the requirement of new accounting standard. So likewise, there could be changes. It's not that you have to apply that consistently forever, but if there is a change, that should be appropriate. Then any changes made to are appropriate, and then data and assumptions used are reasonable. So that's why it says testing how management made the accounting estimate and the data and assumption on which it is based. In doing so, the auditor shall evaluate whether the method of measurement used is appropriate in the circumstances and consistently apply. The data and assumption used by management are reasonable in light of the measurement objective of the applicable financial reporting framework. Right? Then when that is second approach, what is the second approach? Testing how management made the accounting estimate. So we try to understand how they have made the accounting estimate, how they have arrived at the amounts, and try to get the comfort on that. So in that, the auditor is required to test the operating effectiveness of the control over how management made the accounting estimate. What are the controls within the process as part of the company's internal control system? Now let's say you need to, there is you are testing the impairment assessment on trade receivable. So what are the controls within the process? What are the processes and then controls? So we need to test the controls as part of our testing, right? Test the operating effectiveness of the controls over how management made the accounting estimates. So you see now in an audit, there are three stages. Planning stage, in that we understand the entity and its environment, including internal controls. Now there are 5 components coming under internal controls. So we do the understanding part there. What are the 5 components? Control environment, risk assessment, information system and communication, control activities, which is the control at the application level, at the right, and then monitoring of control. So that is the planning phase. We do understanding of the entity and its environment, including internal controls. Now when you say internal controls, we understand 5 components of the internal control framework. What is the purpose? We understand for the purpose of identifying risk of material misstatement at assertion level and at financial statement level. So we do the understanding there. In understanding, we assess the design effectiveness of the control. Design effectiveness of the control. There are two things when it comes to internal control: design effectiveness, operating effectiveness. Now, under planning, we do the understanding part. where we evaluate the internal controls and then assess the design effectiveness. Then the other stage of the audit is after planning, which is execution and evidence building. There we actually, in planning, we identify the risk of material misstatement and decide audit procedures, nature, timing, and extent of audit procedures which are responsive to the assessed risk of material misstatement. Then, at the execution phase or evidence building phase, we perform those audit procedures in order to obtain sufficient appropriate audit evidence. Now, third stage is completion and issue of the audit opinion. Basically, output of an audit is audit opinion, right? Output of an audit is audit opinion. So when it comes to the evidence building, so we would identify some of the accounting. So I explained not all accounting estimate carry higher level of inherent risk. Some accounting estimates are basically they will not have higher level of inherent risk. Some of the accounting estimate we would identify it as significant risk. So during the execution phase, the first approach is obtaining audit evidence from events occurring up to the date of the auditor's report, provide audit evidence regarding the accounting estimate. Then the second one is testing how management made the accounting estimate. That is how they have come up with the point estimate, management point estimate, which is or the disclosure, which is the if you take the management point estimate, that is the amount that is appearing in the financial statement, right? If it is related to a disclosure, then how they have come up with the disclosure, right? As part of that, we test the method and consider whether it is appropriate and consistently applied, and the data and assumption used. Then, as part of our testing, we also need to test the operating effectiveness of the controls we have identified and evaluated for the design effectiveness. If the design effectiveness is not there, then no point of testing those controls for operating effectiveness, which means whether they have been implemented as intended. So that is the purpose of testing the operating effectiveness. The first precondition is the design effectiveness should be assessed and considered to be appropriate, right? Test the operating effectiveness of the controls or how management made the accounting estimate together with appropriate substantive procedure. Now, substantive procedure, there are two aspects: substantive analytical review procedures and test of details. Now, for certain accounting estimate, we would do test of control plus substantive analytical review procedures. As an example, depreciation, we would do a recomputation, or we will do this test of details. Like let's say warranty provision, so we will basically do detail testing, right? So that is the second approach. Third one is, so the auditor developing a point estimate or range. As an example, auditor is developing his or her own amount to compare with the management point estimate. Let's say we actually do an independent calculation to compare with the management point estimate. Let's say warranty provision as per the management accounts is basically 100 million. So we the auditor perform, develop a point estimate if it is 115 million. So there is a misstatement. Depending on the materiality level, we have to consider whether it is a material misstatement or not. So it is there is an under provision for warranty claims. So the management point estimate is 100 million. The auditor's point estimate is 115 million. There is an under provision which may be material or not, depending on the material level. Or auditor could develop a range. So which means, okay, in the same example, management point estimate is 100 million. So auditor develop a range. Now, when it comes to accounting estimate, one thing is it's a judgmental thing. It is very easy to say an accounting estimate is not correct, but if you ask what is the correct one, you are not in a position to say that is what is the correct amount also. But by looking at overall picture, you would say that amount is not right or not in the acceptable range. acceptable range. But somebody asks, okay, if this is not correct, what is the correct one? You can easily say if something is wrong, but it's very difficult to say what is considered to be correct, right? So developing a point estimate or a range. So let's say now the auditor has developed a range. Uh, so based on the auditor's assessment, the provision for warranty claims should be in the range of 125 million to 140 million. If the management point estimate falls within this range, then that is okay. If it is outside the range, and in this case, what is the management point estimate? 100 million, but auditor's range is basically 125 million to 140 million. So there is a misstatement. So we will get the lower end of the range, let's say that is 125 million, and then basically evaluate the misstatement. If the auditor's range is between 90 million to 110 million, the management point estimate falls within that range, then of course we can accept that. So here, third approach to responding to assessed risk of material misstatement is developing a point estimate or a range to evaluate the management point estimate. For this purpose, if the auditors use data assumption or method that differ from management, as an example, if somebody is doing, for investment property, the fair valuation based on the market approach, an auditor believe that their intention is to earn rental income, then income approach to be used. So that the auditor is use a different basically approach, and the method, assumption and data use could be completely different from what have been used by the client, right? If the auditor uses data assumptions or method that differ from management, the auditor shall obtain an understanding of the management assumption or method sufficient to establish that auditor's point estimate or range takes into account relevant variables and to evaluate any significant differences from management point estimate. So if it is, let's say, on market approach, let's say 100, 1 billion, if auditor conclude that the market approach is not appropriate, so you have to use the income approach. So auditor will consider the expected pattern of the rental income and then work out, and then we'll compare. So, right? If the auditor conclude that it is appropriate to use a range, the auditor shall narrow the range based on audit evidence until all outcome within the range are considered reasonable. So these are the basically three approach an audit, the basically auditor could apply. So starting with obtaining audit evidence, if it is not possible, you go to testing how management made the accounting estimate, and in that case, in addition to testing how they have made the accounting estimate, how they have write the accounting estimate, you also need to test the operating effectiveness of the control, provided you have assessed the controls which are going to be tested uh, are appropriately designed. Then if it is that is also not feasible or appropriate, then developing a point estimate or a range, as and then point estimate you will compare with the management point estimate. If it is a range, then you will see whether the management point estimate falls within this range. So these are the three approaches an auditor could take at high level, right? So as I am not going to go through these things, I explain at high level the method, assumptions and data. So you call it MAD, which is a new thing that is introduced under the revised standard. So these things you can go through. So this is at high level, evaluating the reasonableness of the accounting estimate and determining mistake. The auditor shall evaluate based on audit evidence whether the accounting estimate in the financial statement are either reasonable in the context of the applicable financial reporting framework or are misstated. Now, this is management points estimate, that is the amount or the disclosure that is appearing in the financial statement. Then you compare auditor's point estimate or auditor's range of estimate supported with audit evidence, right? And then you have to also to consider changes of accounting estimate or method of making accounting estimate is considered arbitrary, possible management bias. And then if these two are not basically, if there is a difference between management point estimate or auditor's point estimate, or management point estimate does not fall within the range of the auditor's auditors develop range, then there is a misstatement. There is a misstatement. So there are three types of misstatement we discuss. One is the factual misstatement, other one is a projected misstatement, judgmental misstatement. So have you all done ISA 450 standard? Was it part of this course outline? ISA 450. Can somebody just confirm based on the course outline? Are you all doing the ISA 450, which is actually evaluating of misstatement? Can somebody confirm? ISA 540 mean evaluation of misstatement identified during the audit. Right. So there are, under that standard, there are three types of misstatement: factual and then projected. So I will explain at high level. Now, factual misstatement mean misstatement there is no doubt which, if it is material, need to be addressed by management. Factual misstatement, factual, which means there is no doubt. As an example, we have done our testing, cutoff testing on revenue, and identified there is a cutoff error. Revenue is overstated by 100 million. So, which is a factual misstatement, you need to reverse that revenue. Factual misstatement. There is no doubt if it is material, the management has to correct it. Those are called factual misstatement. We have done revenue cutoff testing. We have noted that revenue is overstated by 100 million due to a cutoff error. And that is a factual misstatement. So there is no discussion, no argument, or different point of view when it comes to factual misstatement. The other one is projected misstatement. What is that? Misstatement identified in a sample projected to the entire population. As an example, let's say the inventory value is 100 million. Inventory value is 100 million. So we have selected a sample. Let's say 50 items, that value is 10 million. So total inventory value is 100 million. We have selected the sample. Sample value is 10 million. And we have done the testing. We have tested the valuation assertion. We have concluded that 10 million should be 9 million, which means the sample value is overstated by 1 million. Right? Sample value should be 9 million, but as per the inventory report, it is stated that 10 million. Right? So there is a 1 million misstatement. The sample is overstated by LKR 1 million. So that is a factual misstatement, because you have selected the sample and performed testing, and you have noted that it is overstated by 1 million. That is a factual misstatement. Then, now there is untested value in the population. How much is that? So the total value is 100 million. You have selected for the sample 10 million. In that there was a misstatement of 1 million between an overstatement. Now there is a value that is untested in the population. What is that value? 100 minus 10, 90 million. So you can project. Basically, the misstatement in the sample can be projected to the untested items in the population. Misstatement in the sample can be projected to the untested items in the population. As an example, now here For 10 million, overstatement is 1 million. So for 90 million, projected misstatement is 9 million. I hope you all are clear. Total value of inventory is 100 million. The auditor has selected a sample and the sample value is 10 million. Auditor has performed testing. The based on the auditor's testing, the value should be 9 million, not 10 million. So there is a misstatement of 1 million, which means in the sample is overstated by 1 million. That is a factual misstatement. Now the untested value of the population is 90 million. So which is being projected to the untested, the misstatement in the tested sample is projected to the untested items in the population, which is 9 million. If it is 1 for 10 millions, for 90 million is 9 million. So that is a projected misstatement. Now there is a 1 million factual, 9 million projected. So total misstatement is 10 million. But projected misstatement, you cannot go and ask management to address. But if based on the factual plus projected, if the misstatement is well above the tolerable limit, then what would happen is auditor would extend his testing. He will increase the sample size, or else will ask management to go through the entire inventory valuation and resubmit it. Because the projected, you cannot adjust that in the financial statement, because you cannot say with certainty that misstatement that you have noted in the sample could be there in the untested items. It may not be there, or if you test the untested, it even the misstatement could be much higher than the misstatement we have noted in the sample. I hope you all are clear. The factual misstatement, there is no issue, it has to be corrected. But projected mean the misstatement you identified in a sample is projected to the untested items in the population. But projected misstatement, you cannot ask the client, because you don't know. You ask management to pass an entry only for the factual ones. Only for the factual ones. So basically, in our example, 10 million, 100 million is the value, 10 million selected sample, and there was a misstatement of LKR 1 million, which means the inventory's sample is overstated by 1 million. The based on which we uh, we we can project that misstatement to the untested items in the population. So that will be 9 million total. Factual plus projected would be 10 million, but you cannot go and ask management to correct 10 million, because only factual misstatement can be corrected. So that is the second category of misstatement. Now, when it comes to accounting estimate, it's basically we are looking at judgmental misstatement. Management, sorry, management judgments are unreasonable, or the selection of or application of accounting policies is inappropriate. Judgmental misstatement. It is generally associated with the accounting estimate or fair value accounting estimate. If there are issues with the method, model, or assumptions that have been used by the in the case of accounting estimate, then there could be judgmental misstatement. And those misstatement you need to address at senior level, to understand the reason for the judgmental misstatement, which are arising from the let's say accounting estimate as an example, and then to decide what is the best course of action. So you will get a misstatement when you compare the management point estimate with the auditor's point estimate or auditor's range. If the management point estimate does not fall within the auditor's range, then there is a mistake. Misstatement as per ISA 540 can be, there are three types of misstatement: factual, projected, and judgmental. Judgmental comes based on the different, when it comes to particular accounting estimate, the model or the method or the assumptions or data that has been used, and then whether there is a possible management bias. All that would contribute to a judgmental misstatement, which require to be evaluated at senior level of the engagement team, and then to assess the misstatement level, right? So this is disclosure requirements. Now this is example of accounting estimate, including fair value accounting estimate. Share-based payment, right? SLFRS 2, right? Share-based payment are those payments which are given to employees on the basis of share or equity company, right? So I will just now when it comes to share-based payment, generally accepted model. Now when it comes to accounting estimate or fair value accounting estimate, you need to consider the method or the model, data and assumptions. Now when it comes to share-based payment, generally accepted or used model is Black-Scholes model. That's why is generally Black-Scholes model is commonly used for valuation of share options, right? Now these are the some of the data that is being used. The exercise price of the option, so which is when you grant share option scheme, so that is clearly given in the documents. The life of the option, the vesting period, 2 years, 3 years. The current price of the underlying shares, if it is a listed entity, you can easily get from the market. The expected volatility of the share price, so you will take last 3 months or 6 months of how the price have moved, and then can be calculated. Now these all these data are directly, if it is a listed entity who is offering the share option scheme, you can directly observe with the market data. Now the exercise price of the option, that is the price at which the employees could buy shares. So that is given in the share option scheme itself. So there is no judge subjectivity, right? When it comes to the exercise price, then the life of the option, the vesting period, that is given in the share option scheme. The current price of the underlying shares, you can at the grant date, what is the price? The expected volatility of the share price, the dividend expected on the shares, the risk-free rate for the life of the option. So these are the sum of the. Now, if you see the model is, when it comes to share-based payment, the model generally uses Black-Scholes model, and these are the sum of the input to the model, and that will calculate the fair value at the grant rate, which will be recognized over the vesting period. So that is basically at high level the share-based payment. That is a fair value accounting estimate. So you will see that in this sort of an estimate, the inherent risk could be lower, may not be very high. It will be either low to moderate. Now, when the inherent risk increases, the model or method is entity specific model. The data and assumptions that are used, cannot be observed with market data. So there could be subjectivity, complexity in the model. So likewise, right? And there could be estimation, uncertainty. Can you remember the inherent risk factors, right? Now, if you take the impairment of assets under IAS 36, now see that is a value in use calculation, which is very complex. Entity specific model, data and assumption that are used, basically, method, assumptions and data you cannot observe with market data. Those are entity specific. What management expect to achieve when you do an impairment assessment? As per let's say property plant and equipment, if there are impairment indicators either internal or external, you have to do an impairment assessment as per LKS 36. Only when impairment indicators are there. Now if you take goodwill arising on business combination, you cannot amortize it. You have basically you have got to test the whether the goodwill has suffered an impairment at each reporting date. That is when it comes to goodwill, because you don't amortize, you have to test at each reporting date whether whether the goodwill has suffered an impairment. But when it comes to property plant and equipment, only if there are impairment indicators, you need to do an impairment test. Now, generally, it's basically higher of value in use or recoverable, value in use or fair value less cost to dispose. You compare with the carrying value, and then to see whether there is an impairment. Now, when it comes to impairment of assets, an entity will use its own, entity specific model and the assumptions and data. Now, you see here revenue growth. Can you observe with market data? No. Then EBITDA margin, the change in working capital. So likewise, discount rate, it's very subjective, you know. So then in this sort of an accounting estimate, probably the inherent risk would be considered as very high. Would be considered as high, very high. If you take the spectrum of inherent risk, what are the two things we consider? Magnitude of the potential misstatement and likelihood of misstatement occurring for this sort of an accounting estimate. So that if you go back to our spectrum of inherent risk, so this will be somewhere here. But if you take the share-based payment, because the model is generally accepted, the data and assumptions are used. The data and assumption use can be observed with market data. There is very less. If you take what are the inherent risk factors, estimation, uncertainty, complexity, and subjectivity. So if you take the share-based payments, your assessment of magnitude of potential misstatement and likelihood for a misstatement occurring would be assessed as low, and then in that case inherent risk will be considered as low. But when it comes to an impairment assessment where the model use is entity specific, and then there is a possibility for estimation, high estimation, uncertainty, complexity, and subjectivity. So probably you will assess inherent risk is at high level, and accordingly you will probably recognize that as a significant audit risk, right? So I hope that you understood the concept, basically when it comes to accounting estimate. So actually I showed these two just to show. Just last Sunday I explained that not all accounting estimate carry a higher level of inherent risk. If there is an exam question that all accounting estimate will carry higher level of inherent risk, whether you agree on this statement or not, you have to say no. Why? Not all accounting estimate will carry higher level of inherent risk, right? We have to assess the inherent risk factors and other inherent risk factors. Now these things, right? Inherent risk factors and other inherent risk factors for management bias and change in the financial reporting framework or circumstances, and then to consider the inherent risk factors, right? For us to assess whether the inherent risk attached to the particular accounting estimate to fair value accounting estimate are high, right? These are some of the practice questions. Explain why accounting estimate are considered to be a source of high audit risk, right? Define following inherent risk factors: complexity, estimation, uncertainty, and subjectivity. Accounting estimate, including fair value accounting estimates, are considered to be a key consideration in an audit. And hence, accounting estimate, including fair value accounting estimate, always result in a higher level of inherent risk, higher level of risk of material misstatement. Now, when you say risk of material misstatement, it has two parts: inherent risk and control risk. Discuss whether this statement is true or false. This statement is false. This statement is false. Now, if you take, now I just show you some of the accounting estimate. See, higher level of estimate of an outcome of litigation, impairment assessment of goodwill on non-current assets. So value in useful, that's estimating warranty claims, useful life of PP, estimate of quoted price of shares, estimate of obsolescence, even share-based payment if it is for a listed entity. It is unlikely that the share-based payment would result in a higher level of inherent risk, probably low to medium. But if you take useful life of PP, I explained last week also. Generally, you can easily, what are the generally useful life for the depreciation, right? So if you go back to this, right? So then state this sort of question. If you say true, that is completely wrong. That means you have not understood the accounting estimate, right? State the three approaches an auditor could follow as part of performing further audit procedures in responding to risk of material uh, misstatement associated with accounting estimate. Now, these are the three things, three approaches. When you just give three things: obtaining audit evidence from events occurring up to the date of the auditor's report signing date, testing how the management has made. You can easily explain that method of measurement or the model of measurement use is appropriate and has been applied consistently, and the data and assumption used. And then you have to test the operating effectiveness of the control, which you have assessed the design effectiveness is appropriate. Then developing a point estimate to range, right? Then state the factors an auditor should consider in testing how the management made the accounting estimate under method, assumptions, or data. Now, this which I didn't go through. Whether the method selected, I mean, you don't want to type because it's a typing. If you type one or two, that's enough. When it comes to method, significant assumption, and data. So these are the basically the questions you need to practice. So some of the questions, now if you take question number 3, will carry about 6 marks. This sort of a question, now you have to say state that 3 approach, it will carry about 5 marks. This again, this question would carry about 6 marks. Not that all questions will appear in the exam paper, right? But these are, now define following inherent factors for these 3, 2 marks each, so about 6 marks. Explain why accounting estimate are considered to be a source of high risk. Now, if you see the first couple of slides at high level, I have explained that. So that's all we have to cover under ISA 540. So let me move to basically going concern standard. So are there any questions before I basically start with uh, the going concern standard? If there are any questions, please raise. I mean, or else, you can send a chat message. I will give you about 30 seconds. If there are questions, please ask or send a chat message. I will answer before I start with the going concern. I just want to ask ISA 240. Under ISA 240, I explain why the revenue is considered to be a significant risk. I explain 5 things: incentive or pressure, high volume of transaction, revenue recognition could be judgmental, revenue recognition could be complex, and then in certain industries, the cash sales portion would be very high, like retail industry or something. I said that I will send a couple of slides explaining those 5 points because that is a very important area for the exam. Did I send that presentation explaining the 5 areas which I explained under 240? If somebody who was in that lecture, I don't know whether I sent it across or not. I said that I will send. Did I send that? Under ISA 240. So what I will do is I will resend it. Basically, that question will carry about 8 to 10 marks. So basically, why the revenue? There is a rebuttable presumption that there is a fraud risk in revenue recognition, and under which circumstances that presumption could be invalidated. I explained that if the revenue stream is straightforward, either basically low volume of transaction or simple revenue stream, then we can invalidate or rebut that presumption. What is the presumption? There are risk of fraud risk in revenue recognition. So I will anyway send that tomorrow, right? So let me start with the going concern standard. What is that I have to do? Right. So this one. No? So we are going to start. So can you all hear me?
Yes, sir, can hear.
Right. So we are going to discuss ISA 570 revised going concern. Right. This is a very important standard in the current context because of the certain issues in the business environment. So most of the organization going concern we need to critically assess whether the use of going concern assumption in preparing the financial statement is appropriate. Whether the use of going concern assumption, which is one of the fundamental accounting principles, right? Whether the use of going concern assumption in preparing the financial statement is appropriate or not, right? This ISA deals with the auditor's responsibilities in, in the audit of financial statement relating to going concern and the implication for the auditor's report. ISA 701, which will be done by you all at a future date, in a future session, ISA 701, communicating key audit matters in the independent auditor's report, deals with the auditor's responsibility to communicate key audit matters in the independent auditor's report. ISA 701 acknowledge that when ISA 701 is applied. Now, there were, I will explain in the next slide, right? So what it says is ISA 701 acknowledge that when ISA 701 applies, matters relating to going concern may be determined to be key audit matters and explain that a material uncertainty related to events or conditions that may cause significant doubt on the entity's ability to continue as a going concern it by its nature key audit matter. Keep that for the moment. Let's go to that new slide. Now you see, uh, auditor reporting standard were revised, and then ISO 700 is the standard audit reporting standard. Basically, then ISO 701 was introduced. That was a brand new standard, right? And then ISO 705 modification to the audit report. Can you remember last week we discussed at high level? I explained we have unmodified opinion and modified opinion. So ISO 705 drives the modification to the auditor's opinion. Can you remember? The modification could arise due to two reasons. One is the scope limitations. Other one is when the financial statements are materially misstated. And then depending on the materiality, if it is material, the effect is material and pervasive. Material but not pervasive, we used to issue 4 types of audit opinion. So I'll just show you that. This one, can you remember? Unmodified. And then modification could arise due to scope limitation and departure from financial reporting framework, or financial statements are materially misstated. Then when there is a scope limitation, or when the financial statements are materially misstated, you have to first consider whether the effect is material and but not pervasive, material and pervasive. If it is material but not pervasive, qualified. If it is material and pervasive, disclaimer and adverse, depending on the circumstances under which modification is made, whether it is due to a scope limitation or financial statements are materially misstated. So when you do the auditor reporting standard, you will discuss this in greater detail, right? So you will see that. So there were revisions to the auditor reporting standard. A brand new auditing standard was issued, which is 701. What is that? Communicating key audit matters in the independent auditor's report. So when you do the auditor reporting standard, you will discuss what is a key audit matter, what has to be disclosed under key audit matters. Basically, key audit matters are to be reported in the independent auditor's report of listed entities. Now, if you take any listed entity in Sri Lanka or overseas, you will see key audit matters. So when you do auditor reporting standard, you will understand what a key audit matter is, what is to be included in the key audit matter, what is the thought process to be followed in determining key audit matters. Right? Then ISA 705 is the modification to the auditor's opinion. Then with the auditor reporting standard, ISA 570 going concern standard was also revised. Then other information 720. Other information mean any information other than the financial statement in an annual report or set of financial statement. If you take the chairman review, going concern, corporate governance disclose, management commentary, industry analysis, all that are the information, right? Then revisions were made to ISA 260, which is communicating key audit, communication with those charged with governance, and 706 is inclusion of an emphasis on matter paragraph and other matter paragraph in the independent auditors report. All ISAs. Now, what are these ISAs mean? Auditor reporting standard. These standard ISA 700, 701 is the brand new standard. 705, 570 going concern, which is what we are now discussing. ISA 720, 260, and 706 were subject to revisions, and all these ISAs were effective for audit of financial statements for period ended on or after 15 December 2016 in the global, international context. ISAs. But in Sri Lanka, new revised auditor report was effective for audit of financial statement for period ended on no after 31st March 2018. Now, if you see, now we have applied this new this revised standard and new standard ISA 701 for at least 5 years, right? So that's what, now if you go back to this, what it says is ISA 701 communicating key audit matters in the independent auditor's report deals with the auditor's responsibility to communicate key audit matters in the auditor's report. ISA 701 acknowledged that. What is the ISA 701? Communicating key audit matters in the independent auditor's report, which means in the listed company's auditor's report, right? But it says when ISA 701 applies, matters relating to going concern may be determined to be key audit matters, and explain that a material uncertainty related to events or conditions. So we will discuss what are the events or conditions that may cause significant doubt on the entity ability to continue as a going concern by its nature key audit matter. So that ISA 701 state that when you do ISA 701, as I explained earlier, you will understand what is a key audit matter, what has to be included in the key audit matter, what is the thought process to be followed in determining what matters are to be reported as key audit matters in the independent auditor's report, right? What is going concern assumption? So now we are discussing ISO 570 revised, right? Under the going concern assumption, an entity is one of the fundamental accounting principles. So under the going concern assumption, an entity is viewed as continuing business for the foreseeable future. So that is the going concern assumption. So this so we call it for for a foreseeable future. So we consider for the purpose of accounting 1 year period or quarterly or half yearly for the purpose of reporting financial results. So in preparing the financial statement, what is the assumption? Entity is will continue as a going concern for the foreseeable future. Under the going concern assumption, an entity is viewed as continuing in business for the foreseeable future. General purpose financial statements are prepared. General purpose financial statements are prepared on going concern basis unless management either intends to liquidate the entity or to cease operation. Unless, so which means general purpose financial statements are prepared on going concern basis. Give me a minute. Can you all hear me?
Yes, sir.
Right. So general purpose financial statements are prepared on a going concern basis unless management either intends to liquidate the entity or to cease operation or has no realistic alternative but to do so. No any other choice but other than liquidating the entity. Special purpose financial statement, let's say accounts prepared on a tax basis of accounting or something, may or may not be prepared in accordance with the financial reporting framework for which the going concern basis is relevant. For example, the going concern basis is not relevant for some financial statement prepared on a tax basis in particular jurisdiction. In some countries, now in Sri Lankan context, we prepare the general purpose financial statement in accordance with the accounting standard. And then for tax purposes, they get the accounting profit and certain expenses they add, and certain income they deduct, and then allow the disallowed expenditure and allowed expenditure or something. And then based on the accounting profit, they arrive at the taxable profit or loss. But in certain countries, you need to prepare a set of financial statement, as I understand in India, based on the tax basis. So you have a tax basis financial statement. In that case, the going concern may not be relevant, right? That's what it says. When the use of going concern assumption is appropriate, assets and liabilities are recorded on the basis that the entity will be able to realize its assets and discharge its liabilities in the normal course of business. When the use of going concern is appropriate, so that's why you have not current and non-current assets, current and non-current liabilities. So you expect the entity to continue in the foreseeable future, and then you expect the assets to be realized in the normal course of business. If the going concern assumption is not appropriate, then you cannot have current or non-current classification, because the going concern assumption is not appropriate mean within next 12 months of time, the either management intends to liquidate the entity or to cease operation or has no realistic alternative but to do so, right? So I hope you are clear. When the use of the going concern assumption is appropriate, assets and liabilities are recorded on the basis that the entity will be able to realize its assets and discharge its liabilities in the ordinary course of business. That's why you have current and non-current classification. Now, some of the examples. Let's say an oil and gas firm operating in Sri Lanka is stopped by Sri Lankan court carrying out operation in Sri Lanka, which means their license has been revoked or suspended by the court order. Now, if you go, general purpose financial statements are prepared on a going concern basis unless management either intends to liquidate the entity or cease the operation or has no realistic alternative but to do so. What do you mean by but to do so? To liquidate the entity. They have no other choice other than liquidating the entity. Now, in this case, what is that? An oil and gas firm operating in Sri Lanka is stopped by a Sri Lankan court from carrying out its operation in Sri Lanka. So they have no choice other than liquidating it because they cannot operate. So they have been suspended by a court order. So in that case, can they prepare the financial statement on the basis entities are going concern? No. So they have to prepare the financial statement on a different basis. What if that basis is liquidation basis or breakup basis, whereby current non-current assets will also be non-current assets will be classified as current to their realizable values. Then non-current liabilities will also be classified as current at their settlement values, and you may recognize any liabilities that may arise in the case of a liquidation. As an example, the payments relate to basically VRS payment, voluntary retirement provisions, voluntary retirement cost, and then any other costs associated with the liquidation. So in this case, I hope you are clear. An oil and gas firm operating in Sri Lanka is stopped by a Sri Lankan court from carrying out operation in Sri Lanka. So the firm is not a going concern in Sri Lanka because it has to be shut down because the management has no realistic alternative but to do so. Then other one. A nationalized refinery is in cash flow problems. Now, as an example, Sri Lankan Airlines, it has cash flow problems. But the government of the country provided a guarantee to the refinery to help it out with all the payments. So now you will see that there are events or condition. So we will discuss these events. There are three categories of events or condition: financial, operating, and other. So there are events or condition that may cause significant doubt on the entity's ability to. There are events. So give me a minute. Right? Nationalized refineries in cash flow problems, but the government of the country provided a guarantee to the refinery to help it out with all payments, which this mean there are events or conditions in the form of financial, operating, and other, which may cause significant doubt on the entity's ability to continue as a going concern. But based on the management going concern assessment, they expect government of the country will continue to provide guarantee to the refinery to help it out with all payments. So there are events or conditions that may cause significant doubt on this particular entity ability to continue as a going concern, but there are mitigating factors. Accordingly, despite the events or conditions, the use of going concern assumption is appropriate because based on the management assessment of going concern, the government of the particular country has provided a guarantee to the refinery to help it out with all payments. So then the conclusion is the refinery is a going concern despite poor financial position. Or in other words, despite having events or conditions that may cause significant doubt on the entity's ability to continue as a going concern. Now, third one, a bank is in serious financial troubles and the government is not willing to bail it out, which means the government says we are not going to support you. The board of directors has passed a resolution to liquidate the business. In that case, so they are the what is that it says how get link management either intends to liquidate. So they have passed a resolution which means they intend to liquidate the business. So the bank is not a going concern. So you cannot prepare the financial statement on the basis entity is a going concern. That is the same related to example number one. But when it comes to number two, despite having events or condition, the entities are going concern. Still, the use of going concern assumption in preparing the financial statement is appropriate. Accordingly, management can prepare the financial statement on the basis the entity is a going concern. Now, let's go to the other one. A merchandising company has a current ratio below 0.5. This means it has a net current liability position, which means basically its current asset is half of the its current liabilities. A creditor with US dollar 1 million demanded the payment which the company could not honor or to make. The creditor requested the court to liquidate the business and recover his debt, and the court grants the order. So what is it says? Unless management either intends to liquidate the entity or cease the operation or has now with the court order, management has no realistic alternative but to do so. So the entity is not no longer going concern, which means they cannot prepare financial statement on the basis the entity is a going concern. Right? Now the fifth one, the entity exists making continuous losses or persistent losses. As an example, Ceylon Petroleum Corporation or Ceylon Electricity Board. Over the years, as a result, its net assets are deteriorating with a net current liability position, which means they are now when you have persistent losses, what happened? You end up with accumulated losses. Sometimes certain companies you have negative net worth. You have negative net worth, which means the accumulated losses basically have wiped out the share capital and reserves. And then generally when you have persistent losses, you have net current liability position. So you have many events or conditions that may cause significant doubt on the entity's ability to continue as a going concern. The parent entity has provided a letter of financial support. Now, this entity has a parent entity that it will render all necessary financial assistance for next 12 months to allow the entity X to continue in business. Now, next 12 months under the standard, basically we have to consider 12 months window from the date of approval of the financial statement, not the date of the balance sheet, right? So what it says, it will render all necessary financial assistance for next 12 months to allow the entity X to continue in business without curtailing any of its major operations. So you will understand there are just like point number two. In this case also, there are events or conditions that may cause significant doubt on the entity ability to continue as a going concern. But based on the management assessment of going concern, they have received a letter of financial support from the parent company, and it has confirmed that it would render necessary financial assistance for next 12 months from the date of the financial statement to allow the entity X to continue in business without curtailing any of its major operations. So, despite having these events or conditions that may cause significant doubt on the entity ability to continue as a going concern, the use of going concern assumption in preparing the financial statement is appropriate, and accordingly, the financial statement can be prepared on the basis the entity is a going concern. That's what it is. The entity is a going concern despite its poor financial performance and position. Now, this is a real life scenario, so I have taken 2019-20. I mean, it would discuss. Now, this is the going concern. Now, Sri Lankan Airlines. Now, this is the going concern. Now, it says first they explain events or conditions that may cause significant doubt about the Sri Lankan Airlines ability to continue as a going concern. Events or conditions, right? I'll just go to those slides. Now, there are three events or conditions under three categories: financial, operating, and other, right? Now, going concern note in Sri Lankan Airlines. You all know that Sri Lankan Airline is making persistent losses and its net assets are deteriorating. It has net current liabilities, but still it prepare the financial statement because the government provide the letter of support, right? Do you see now at high level these are the events or conditions. During the current year, the company has recorded a loss, an accumulated loss. Further, company's current liabilities exceeded its current asset, which means there is a net current liability position. And total equity of the company as at the reporting date has declined to a negative value. That means accumulated losses have wiped out stated capital and reserves, which means there is a negative net worth. If you see the Sri Lankan Airlines balance sheet, you have a negative net worth. Now, generally, net assets should be a plus figure, no? But in the Sri Lankan Airlines, uh, 2019 and 20, it had a negative net worth of 273 billion, right? Which means it has a serious loss of capital as per the company's Act number 7 of 2007. Now, serious loss of capital mean if your net asset is less than half of the stated capital, If your net assets are less than half of the stated capital, then it is considered to be a serious loss of capital. Let's say if your share capital is 100, your net assets is 70, mean your net assets are higher than half of your stated capital. Now, what is the stated capital? 100. What is the half value? 50. What is your net assets value? 70. That means there is no serious loss of capital situation. If it was 40, then 40 is less than 50. So there is a serious loss of capital. If your net assets are less than half of the stated capital as per the Companies Act, it is considered to be a serious loss of capital situation. Now, in Sri Lankan Airlines, they have negative. So they are in a serious loss of capital situation. Then they have given the group point of view also. This was it says the company net assets are less than half of the stated capital and face a serious loss of capital situation. So, as per the Companies Act, the company has conducted an extraordinary general meeting on 25th and discussed the proposal presented by the directors in accordance with the Companies Act number 7 of 2007, section 220. With the outbreak of COVID-19, the operating environment has become uncertain and challenging. The airline industry globally faces its gravest crisis in the modern times due to COVID-19 pandemic, right? You will see there. Now it says that okay, events and conditions they have given. The management of now, then the mitigating factors, how they just based on their going concern assessment, how they justify, despite having these events or conditions, we can still use the going concern assumption in preparing the financial statement. That means use of going concern assumption is appropriate despite the events or condition. Now these are the events or conditions, right? Now what it says, the management of Sri Lankan Airlines has already taken measures to preserve the liquidity by negotiating deferred payment plans and concession with the airline key suppliers. Whilst doing so, the airline is continuously looking at creating new business opportunities, whilst focusing on cost saving measures to improve liquidity. So, they are focusing on one is deferred payments to the key suppliers, and then looking at new business opportunities and then cost saving measures. One is to ensure the working capital by deferred payment, and then to increase the top line and then reduce the expenses. Give me a minute. Right? So they are focusing on the deferred payments, top line growth, and then the cost reduction. The budget 2021 is prepared after the incorporating several initiatives in the areas of leases, staff cost optimization, and new revenue stream, including enhancing the cargo operation. Management is continuously pursuing further opportunities. Now, this you will see events or condition, then the management assessment of going concern with mitigating factors. Further, the plan considers step to negotiate with Airbus on the pre-delivery payments made for Airbus A350 to 900 aircraft as detailed in Note 6 to the financial statement. Other measures included mandatory salary reduction from staff starting from 2.5% to 25%, freezing all salary increments to be implemented in the year 2020. Further, special no-pay leave scheme was introduced to staff from March 2020 to till 30th October 20. So these are the cost reduction measures. So they are just, these are the mitigating factors based on their assessment of going concern. Then the other one, the GOSL continued to support the company and during the year under review has approved the reissuance of all letters of comfort that expired during the period amounting to US dollar 2.54 million and LKR 27.6 billion in favor of two state banks, which is BOC and People's Bank. in order to continue with the provision of short-term loan facilities. Now, in addition to their internal measures to improve the performance, the government of Sri Lanka has also issued letter of comfort. The GOSL has also reissued a sovereign guarantee of US dollar 179.5 million in June 2009, which enabled the company to refinance an international bond that matured on 27. They have issued an international bond, so the government has given a guarantee, so they have been able to refinance that. Also, subsequent to the reporting date, based on the cabinet approval to provide treasury guarantee to State Bank have approved new facilities of US dollar 75 million for working capital purposes. Further, the GSL by way of cabinet approval dated 17 June 2020, the letter issued by the Secretary of the Treasury on 29 June 2020 has confirmed that the GSL will continue to extend required financial support to the company to continue its operation as a going concern until the implementation of the proposed restructuring plan. Now you will see that there are events or conditions and the management plan of action to justify why, despite having these events or condition, why the use of going concern assumption is still appropriate, right? So the entity is a going concern despite its poor financial performance and position due to following mitigation action as per the management assessment of ability to continue as a going concern. Now you'll see that is basically this is the going concern note of the Sri Lankan Airlines. Now Sri Lankan Airlines or Ceylon Petroleum or CEB continue to depend on the government funding accordingly. Despite having persistent losses, I don't know now the situation of petroleum and CB with the tariff hike and then the fuel prices increases. But up to last year, based on the government letter of support, they continued to prepare the financial statement on the basis of a going concern, despite the events or conditions noted that may cause significant doubt about the entity's ability to continue as a going concern, right? Responsibility for assessment of the entity ability to continue as a going concern. Some financial reporting framework contain an explicit requirement for management to make a special assessment of the entity's ability to continue as a going concern and standard regarding the matters to be considered and disclosures to be made in connection with going concern. For example, LKS1 or IS1 required management to make an assessment of the entity ability to continue as a going concern. So that is management responsibility. For a profit-oriented entity, it may be a very straightforward assessment, but that is a requirement as per IS1. If you take John Keel's Holding or Haley's PLC or Dialogue, which are very profitable, or let's say Chevron Lubricants, which are very profitable, that is a very straightforward assessment. But if you take entities like Sri Lankan Airlines, Petroleum, or CEB, or any other loss-making entity, it's a detailed piece of work. But as per IAS1 or LKS1, it's management responsibility to make an assessment of an entity's ability to continue as a going concern. Management assessment of the entity ability to continue as a going concern involves making a judgment at a particular point in time. So basically, so you consider of the foreseeable future, which is 12 months from the date of the approval of the financial statement, right? You make it at a particular point in time. At the time of the approval of financial statement for issue, about inherently uncertain future outcomes of events or condition factors to consider. Now, foreseeable future means 12 months period. It's not 5 year or 10 year. You cannot forecast for that long, right? The degree of uncertainty associated with the outcome of an event or condition increases significantly the further into the future an event or condition or the outcome offers. So basically the period is 12 months. The size and complexity of the entity, nature and condition of its business, and the degree to which it is affected by external factors. So all that will be impacted. Now, if you take the apparel sector, the export sector, now you see the apparel sector during the last quarter, the apparel sector actually recorded the lowest the export income, about 318 million, right? 318 million. The last 6 months, due to during the COVID period, most of the international buyers like Nike or PVH or Next, they basically uh, they purchase inventories and they had in the stock. Now, of course, there is high inflation in US and in there is kind of a recession, so that they don't place new orders. So as a result, during the last 6 months, it has significantly affected the export sector, particularly apparel sector, which has recorded the lowest in April, about 318 million. And if you compare the first 3 months of the year also, the export proceed from the export sector, the apparel sector has come down. So these are some of the the complexity, the status of the industry. Just because you have been profitable in the last year doesn't mean that you will continue. It's a straightforward assessment. You have to consider the complexity of the entity, nature and condition of this business. Now, if you consider the leisure sector, the last year they towards the latter part they were the hotels, they were making losses. But if you take the starting from October, November, up until now is actually off season, so up to April, so the leisure sector was doing well. So just because of you had losses, you have to consider the current status of the industry, how it is moving, right? Any judgment about the future is based on information available at the time at which the judgment is made. So it is at a point in time, right? Subsequent events may result in outcome that are inconsistent with judgment that were reasonable at the time they were made. Now that's why at the point of making the assessment, you have to consider these factors. But after that, the factors that were existed at the time of making the going concern assessment may change. But that you cannot help. Now, I explain in the accounting estimate also, uh, if there is a difference between the actual amount of an accounting estimate and the value of the accounting estimate, that doesn't mean that's a misstatement. Because when it comes to accounting estimate, you look into the future based on the best available information, and then you consider the method, assumptions and data, and you arrive at the estimate. But the actual outcome may be totally different from the assessment. But as long as you can prove that you have taken into account the best available information at the time of making the accounting estimate, then there is no mistake. The same way, any judgment about the future is based on the information available at the time at which the judgment is made. What is the judgment? Whether the entity can continue as a going concern or not. Subsequent event may result in outcome that are inconsistent with judgment that were reasonable at the time they were made. So you cannot do anything about that, right? So this the LKS1 presentation of financial statement require that when preparing the financial statement. This is the accounting standard perspective, right? Require that when preparing the financial statement, management shall make an assessment of the entity ability to continue as a going concern, right? Give me a minute. Right? An entity shall prepare financial statement. Can you all hear me?
Yes, sir.
Right. An entity shall prepare financial statement on going concern basis unless management either intend to liquidate the entity or to cease the trading or has no realistic alternative but to do so. The assessment should cover 12 months period from the end of the financial period or from the date of the based on the auditing standard based on the date of approval of financial statement. The foreseeable future mean 12 months window, right? When management is aware of making its assessment, what is that assessment? Going concern assessment, which is required under LKS 1. when management is aware of in making its assessment of material uncertainties related to the events or condition that may cause significant doubt upon the entity ability to continue as a going concern, the entity shall disclose those uncertainties. That is what Sri Lankan Airlines had disclosed. Now, these are the significant uncertainties. Events or conditions that cause significant doubt about Sri Lankan Airlines ability to continue as a going concern. Then mitigating factor based on the management assessment of going concern. Right? When an entity does not prepare its financial statement on going concern basis, it shall disclose the fact together with the basis on which it is prepared, with the basis on which it prepared the financial statement and the reason why the entity is not regarded as a going concern. When we discuss the auditor reporting conclusion related to going concern, I will show you. That is when the going concern assumption is not appropriate and the management is not preparing the financial statement on a going concern basis. Right? The objective of the auditor are to obtain sufficient appropriate audit evidence regarding the appropriateness of management use of going concern assumption in the preparation of financial statement. What is the first objective? To obtain sufficient appropriate audit evidence regarding the appropriateness of management use of going concern assumption in the preparation of the financial statement. The second one, to conclude, based on the audit evidence obtained, whether material uncertainty exist related to event or condition that may cause significant doubt on the entity's ability to continue as a going concern. So first we have to obtain sufficient appropriate audit evidence regarding the appropriateness of management use of going concern, and then to conclude, based on the audit evidence obtained, whether material uncertainty exit relate to events or condition that may cause significant doubt on the entity's ability to continue as a going concern. The concept of material uncertainty we will discuss as we go on. To report in accordance with this ISA. To report mean auditor report in conclusions related to going concern. So we will discuss. This responsibility exceeds even if the financial reporting framework used in the preparation of financial statement does not include an explicit requirement for management to make a specific assessment of the entity ability to continue as a going concern. But as per LKS 1, it is a requirement, right? IAS 1, right? Now, same way, you have to do the risk assessment procedures and related activities for the purpose of identifying risk of material mistake. If you take Sri Lankan Airlines, definitely they would have identified the entity's ability to continue as the auditor is basically auditor general, but it is done by another audit firm and they report to the auditor general, and based on that report, auditor general issue the report. So based on the, as far as the Sri Lankan Airlines is concerned, definitely the going concern will be considered as a significant audit risk because there are many events or conditions that may cause significant doubt on the entity ability to continue as a going concern, right? The risk assessment procedures and related activities. When performing risk assessment procedures as required by ISA 315 revised, the auditor shall consider whether there are events or conditions that may cause significant doubt on the entity ability to continue as a going concern. What are those events or conditions? There are three categories: financial, operating, and other. The first one is that whether there are events or conditions. May not be the case for a very profitable entity with forecasted profit for the future. If you take John Keel's holding or Dialogue or a very reputable bank or Haley's Group, you will not identify events or condition. In doing so, the auditor shall determine whether management has already performed a preliminary assessment of the entity ability to continue as a going concern, because it is a requirement under IAS 1 for the management to perform a going concern assessment. It may be straightforward one or a detailed piece of work, as in the case of Sri Lankan Airlines. Then the risk assessment procedures required to help the auditor to determine whether management use of going concern basis of accounting is likely to be an important issue and it's impact the planning of the audit, which means based on this, auditor will conclude whether the assessment of going concern is a key area in the risk assessment process, whether that has to be considered as a or treated as a significant audit risk or a risk of material misstatement. The auditor shall remain alert throughout the audit for audit evidence or evidence of events or conditions that may cause significant doubt on the entity ability to continue as a going concern. Right? So it's not that you stop at planning state, but you need to consider that throughout the audit and to see whether there are events or conditions that may cause significant doubt about the entity ability to continue as a going concern. Now, these are the certain, the events or conditions that may cause doubt about going concern assumption or entity's ability to continue as a going concern, either individually or in aggregate. Net liability or net current liability position. Now, Sri Lankan Airlines, both are there. Fixed term borrowing approaching maturity without realistic prospect of renewal or repay, or excessive reliance on short term borrowings to finance long term asset. Now, if you want to fund a non current asset, generally you get long term funding. Indication of withdrawal of financial support by creditors. Negative operating cash flows indicated by historical or prospective financial statement. Adverse key financial ratio. Substantial operating losses or significant deterioration in the value of asset used to generate cash flows. Arrears or discontinuation of dividends. Inability to pay creditors on due date. So working capital issues. Inability to comply with the terms of the loan agreement. So complying with the loan covenants. Change from credit to cash on delivery transaction is supplies. So suppliers are not granting credit period anymore. Inability to obtain financing for essential new product development or other essential investment. As an example, telco company, now they need to invest in 3G, 4G, 5G likewise. If they don't have funding to invest in the new technology, they will get outdated. But these are events or conditions which may cause significant doubt about the entity's ability to continue as a going concern. But that doesn't mean that entity cannot prepare the financial statement on the going concern basis. That is based on, we have to decide based on the management going concern assessment, which is required on IAS 1. Now, Sri Lankan Airlines, they have prepared their internal focus, basically deferred payment for suppliers, cost reduction measures, right, and then the revenue enhancement measures, and then the letter of supports from the government. So once you identify events or condition, then basically you have to uh, basically perform testing over the management assessment of going concern to conclude, despite having these events or conditions, still the use of going concern assumption is appropriate or not appropriate, right? So you see the sequence: events or condition, management assessment of going concern, then auditors testing, and then the conclusion. Auditor's conclusion may be different to management conclusion, right? Then operating. Management intention to liquidate the entity or to cease operation. Loss of key management without replacement. So likewise, you can read these things. So these are all events or conditions that may cause significant doubt about the entity ability to continue as a going concern. Now, evaluating management assessment. What is that? Management assessment of going concern, which is required under LKS 1. The auditor has a responsibility to evaluate whether there is a substantial doubt about the entity's ability to continue as a going concern for a reasonable period of time, at least 1 year period beyond the date of the financial statement being audited. That is called foreseeable future, at least 12 months. Steps in the going concern evaluation. Now, who is responsible to perform the going concern assessment? Management. So, what is auditor's responsibility? To perform audit testing over the management assessment of going concern to obtain sufficient appropriate audit evidence whether the management use of going concern is appropriate or not. Step 1 is consider if the results of all audit procedures performed during the audit indicate whether there is a substantial doubt about the entity ability to continue as a going concern for a reasonable period, at least 1 year from the date of the financial statement. That is risk assessment level. Step 2, if there is a substantial doubt, as an example in the case of Sri Lankan Airlines, the auditor should obtain information about management plans to mitigate the going concern problem and assess the likelihood that such plans can be implemented. Now, the mitigating actions. So, what are the management plans to mitigate the going concern problem if you go to Sri Lankan Airlines? So, the management Sri Lanka Airlines, so these are the mitigating actions. So, they are saying that, okay, we have a problem, events or condition, but we have a going concern assessment which with mitigating actions, and we believe that the use of going concern assumption is appropriate, right? Then step 3, if the auditor conclude after evaluating management plans that the entity has a going concern problem, auditor should consider the implication to the auditor's report. Based on the audit evidence obtained, the auditor will consider whether there are any implication to the auditor's report in relation to going concern. So that is at high level the process, right? Evaluating the management assessment shall cover the same period as that is used by the management to make its assessment, which is 12 months from the date of the financial statement. If the management assessment of the entity ability to continue as a going concern covers less than 12 months from the date of the financial statement as defined in ISA 560 subsequent, the auditor shall request management. So basically the minimum period required 12 months. If they have given for 6 months, then you have to ask for the 12 months period. In evaluating the management assessment, the auditor shall consider whether management assessment includes all relevant information of which the auditor is aware as a result of the audit. Auditor shall evaluate of the process management followed to make its assessment. So we need to understand the the process management has followed to make the going concern assessment. The assumption on which the assessment is based on. As an example, Sri Lankan Airlines, they expect the new revenue growth, right? And then they improve the cargo operation, right? And management plans for future actions and whether management plans are feasible in the circumstances. The auditor shall evaluate management assessment of the entity ability to continue as a going concern, right? So the bottom line is that management has to perform the going concern assessment, and the auditor shall evaluate that. And based on the audit evidence obtained, it will have reporting conclusion on the auditor report, right? Additional audit procedures when events or conditions are identified. Now, what are the events or conditions which we just discussed? Financial, operational, or others. The auditor shall obtain sufficient appropriate audit evidence to determine whether or not a material uncertainty exists through performing additional audit procedures, including consideration of mitigating factors. If events or conditions have been identified that may cause significant doubt on the entity ability to continue as a going concern, the auditor shall obtain sufficient appropriate audit evidence to determine whether or not a material uncertainty exists. So I will explain what is material uncertainty, right? Through performing additional audit procedures, including consideration of mitigating factors. If there are events or conditions, and then management has performed the going concern assessment, when auditor is evaluating the management assessment of going concern, the one important thing the auditor has to determine whether or not a material uncertainty exists. I will explain why is that and what is material uncertainty, right? Right, through performing additional audit procedures, including consideration of mitigating factors. Where management has not yet performed an assessment of the entity ability to continue as going concern, requesting management to make its assessment because that is required under IES. Evaluating management plans for future action in relation to its going concern assessment. whether the outcome of these plan is likely to improve the situation and whether management plans are feasible in the circumstances, which we discussed earlier as well. Where the entity has prepared a cash flow forecast. Now, how do you do it for 12 months period? Now, going concern doesn't mean you have to be profitable. It is whether you can continue your operation without curtailment of your operations. It is whether you can sustain the business. It is not about making profit. There are many organizations in the world making losses but continue to sustain due to letter of support or corporate guarantees and the unused banking facilities likewise. Those are mitigating factors. So generally, in the going concern assessment, we ask for a cash flow forecast. Basically, based on the 12 months period budgets, we get a cash flow forecast just to see whether they can service, they can meet expenses. Simple as that. Where the entity has prepared a cash flow forecast, an analysis of the forecast is a significant factor in considering the future outcome of events or condition in evaluation of the management plans for future action. Evaluating the reliability of the underlying data generated to prepare the forecast. So when we get the cash flow forecast, so you need to consider the reliability of data, determining whether there is adequate support for the assumption underlying the forecast. Now, the cash flow forecast is prepared based on the budgets. So the budgets will have the expected revenue growth and then the expected, the cost reduction and then expected funding from the parent company if there is a letter of support or something like that. Use of unused banking facilities likewise, right? In addition to the procedures required, the auditor may compare the prospective financial information for recent prior period with historical result. That is, to see whether, if you consider the historical budgets, whether the actual are way below the budget, so their budgets and actuals corresponds to each other with minimal variance, just to see the reliability of their forecasting, right? The prospective financial information for the current period with results achieved to date. So that is basically to see whether in the past whether the management uh, budgets reflected basically reflected acceptable results. If the budgets and actuals are different to each other with material variances, it's unlikely that the auditor can rely on the budgets prepared by management, right? Considering whether any additional facts of information have become available since the date on which the management made its assessment. So after the management assessment of going concern, whether there are any facts or information which may impact the management assessment of going concern. As an example, a customer has rejected the order or they have cancelled order which they have forecasted as revenue. That will impact the going concern assessment, because going concern assessment, as I explained earlier, basically it reflect it assess based in a point in time. So during the audit, the auditor has to uh, consider whether there are facts or information that would affect the management assessment of going concern. As an example, if a customer has cancelled order place which has been considered in the budget, definitely it will impact the going concern assessment, right? Requesting written representation, management representation letters from management, and we have prepared those charged with governance regarding their plans for future actions and the feasibility of the plan. So this is a illustrative representation. I mean, you all can go through, right? Factors mitigating the substantial doubt about the going concern. Now, events or conditions identify which may cause significant assessment of going concern. Now, these are the additional audit procedures when events or conditions are identified. If it's a very profitable entity and expecting to earn good profit, and even after the year end they have earned profit, auditor will not go to this extent. Now, these procedures will be performed if events or conditions have been identified which may cause significant doubt on the entity's ability to continue as a going concern. This may be the case when it comes to Sri Lankan Airlines audit. Now, factors mitigating the substantial doubt about the going concern. Income factors. Now, you saw plans to expand sales in existing markets and introducing new products or services expansion into new markets. Now, can you remember they stated that they are, assessing the cargo operation. Then asset factors, sale of assets or delayed replacement. Debt factors, unused lines of credit, ability to renew or extend existing loans or comfort letters. So income factors, assets factors, debt factors, and then cost factors. Ability to reduce the cost, restructuring, retrenchment, downsizing plans. Equity factors, additional contribution from owners, subsidiaries, or associates. So either in the form of share capital or through interest-free loan or funding, right? Or through letter of support. Now comfort letters. Now in the examples also we discuss letter of support. There are two types of letter of support and letter of subordination, where management assumptions include continued support by third parties, whether through the subordination of loans, commitments to maintain or provide additional funding or guarantees, and such support is important to an entity's ability to continue as a going concern. The auditor may need to consider requesting written confirmation from those third parties and to obtain evidence of their ability to provide such support. Now, in the case of Sri Lankan Airlines, the government of Sri Lanka has issued comfort letters. Accordingly, the auditor needs to confirm arrangement made with third parties concerning provision of additional finance to support the audited entity and the capacity of the third party to provide promised support. So that is also very important. I can remember one of the entity in Sri Lanka where the parent company was in German. So this entity was making losses, but then the parent company issued the this particular company was making losses, and then the other company, the parent company, issued the letter of support. Then we requested the financial statement of the parent company, and that is also making persistent losses. It has no capacity to support the parent company subsidiary in Sri Lanka. So that's why it's very important the capacity of the third party, the capacity of the third party to provide from his support. Now in Sri Lankan Airlines, the government has given. So the government considered to be the most credit worthy, and then they have the capacity. But if loss-making entity is giving the letter of support, unlikely that auditor can accept that as a mitigating factor. Often, a parent entity or another related undertaking will support subsidiary in the financial difficulty. Now, there are two types of letter of support. Letter of support, parent agrees to provide financial assistance to subsidiary for a fixed period. Now, that is what it says. Can you remember? The entity X is making continuous losses over the years, and as a result, its net assets are deteriorating with net current liability position. The parent entity has provided a letter of financial support that it will render all necessary financial assistance for next 12 months to allow the entity X to continue in business without curtailing any of its major operations, right? Right? So letter of support. Then letter of subordination means parent agrees to not to demand the repayment of financial debt. Let's say if there is significant amount payable to the parent company, it will not. If you take that out, you are in a kind of a better position, net current asset position. So in addition to giving the letter of support, they would also state that I will not ask for the repayment of amount due by the company to me until the company is in a position to repay that. That is called letter of subordination, right? Uh, so we have some areas to cover. Just is Natasha is still on the call? Natasha, are you on the call? Yes, I want to ask whether I can continue or to stop and do it in another day. So what I should do? So can somebody, can I continue until the end? Because we have a couple of slides and then the auditor reporting conclusion, which would take some time. My suggestion is to do it on another day. So we have another standard also to do ISA 550, which is actually not a big one, and I will not take long time. But the standard I have basically some slide, uh, at least another 18 slide, which would take some time because you cannot rush. It has to be done in proper order. I'm not
Excuse
sure.
me, sir.
Yes, Natasha. Now, Natasha, there are about 18 slides, and
Yes, sir.
which is primarily related to audit procedures and then the auditor reporting conclusion on going concern, which would take some time. I don't think if I do now, it will take at least more than an hour, so
Okay,
may
sir.
not be effective. So
Hmm.
my suggestion would be for us to do another additional session, depending on the students' availability, either on next Wednesday or weekend, depending on their availability. But this weekend we will have Poson, right?
Yes, sir. Saturday poson.
Poson. No, Sunday, I don't know. The students will go home, no, during the
Yes,
weekend.
most.
But let's discuss with Dr. Ajwad and see what is the
Yes.
feasible date for me to do. Even I can do next week as well, depend if the other lecturer can uh,
The thing
give
is,
me the
sir,
time.
this Wednesday is the last day of the academic calendar, semester last
How
week.
I see.
Yeah.
Ah,
So,
okay. So
but
are you all not
weekend
doing
we
the
can.
ISA? No, Natasha, just to ask, this ISA 700 and all that not in the course
Yes, sir.
outline?
Now we are having additional lectures, special additional lectures because we couldn't finish, sir. So if we
Ah, okay.
can discuss with Ajwat, sir, we can arrange one session, sir. Most probably.
Ah, okay. I will not take more than 1.5 hours
Okay.
to complete the balance part of going concern and then the related part, which of course I will not go into detail.
Yeah.
But the going concern, I just don't want to rush it because auditor reporting conclusions are very important.
Mm.
There
Okay,
will
sir.
be exam questions and all that. Otherwise, students will find it difficult to
Yeah.
answer. So
Yeah.
I will. Shall I conclude the lecture for today, and then
Okay.
let's communicate the students the date for the additional lecture, right?
Okay, sir. Sure.
Okay, then thank you very much. Up to now, what we discuss, if there are any questions you could raise. If not, basically you could raise on the other day as well. So I'm okay. I will give 30 seconds. If there are any questions, either you can raise it or you can send a chat message before we conclude today's session. It appears that there are no questions. Ah, yes, there is. Thank you. Okay. So let's meet up again. I will once again do a high level overview what we have discussed today. Going concern standard is very important whether you work in the industry or practice in firms. Something which you need to understand very clearly, particularly the auditor reporting conclusions and the process to be followed until you arrive at that position. So, Natasha, with that, let me conclude the session so that we will discuss separately, right?
Okay, sir. Thank you very much, sir.
Thank you very much. Good night to everyone. Right.
Good night, sir.
Thank you very much, sir.
Okay.